Welcome to the channel again. If you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to have a look at today's stock, which is Dollar General Corporation, ticker DG, trading at $160 and reporting earnings very soon. Now, with this one, I have decided to stick it on the watch list for now, see how earnings turn out, although arguably Uh, it could be the other way around. I could potentially, depending on how earnings of its competitor Dollar Tree turn out tomorrow, change my mind and enter ahead of earnings. And the reason why that is I'm generally speaking bearish on dollar stores. Inflation is no longer a threat to the consumer, as evidenced by the latest reading, which came in line of expectations at 3%. Because of this, I think consumers have gradually stopped seeking value so much compared to previous years. We saw many low consumer and even higher income consumer um, flocking to these type of stores looking for that value because of the prices. And so at the same time, we have seen the UMCSI, the University of Michigan Consumer Sentiment Index, rising significantly over the last 3 months. So it went from 61 to 77, which is a very rapid increase. Now the stock, as you can see over here, is sitting right now under a multi-year resistance level. And I think there's a solid prospect having reached this level to drop quite significantly. But if we look closer, when we were in October, when it was trading at 100, the stock is up 60% since essentially October. It's had a very, very good run. And I don't think that there's much more headroom for the company to keep going up. At the moment, is trading at a higher premium than the S&P 500, which, yes, it has outperformed slightly historically. However, you have to question why would we want to own this company at a higher premium than the S&P 500, considering that is obviously more risky, right? But also considering that the company is not expecting EPS and sales growth over the next 2 years. As a matter of fact, 2023, yes, they had a bad year. Earnings were down 30%, but what comes next is not that great either. They're expecting to increase EPS by less than 1% in 2024 and just over 11% in 2025, all coupled with lukewarm sales growth. So we have to ask ourselves, why would we pay more for this stock rather than the S&P 500? Because that's what is trading at the moment, and it's currently, as you can see here, oversold on the technicals. So that creates, in my mind, a bearish point for the stock. Now, as a matter of fact, the company is near all-time high valuations reached during the 2022 period. If we look at this from a valuation perspective, right? We are currently at 22.5, but if we go to the 2022 period, the stock was trading at around 22 to 18 times next 12 months earnings. So we are pretty much on the high end. The maximum that it reached was actually 24. So we're kind of in a higher end of the highest that's ever been. And as we can see here, those kind of peaks have led over, as you see how these lines keep going up and down, over periods of 3 to 6 months have created those seesaw fluctuations in the stock. So I think we are due to reach that ceiling, and the stock could be due for a pullback after that. The same applies if we look at the stock, by the way, from an EV to EBITDA lens. So it's in a similar fashion in terms of the valuations that we saw during those 2020, 2022 years. Now, if we look at where the stock is sitting compared to the analyst expectations, yes, we are quite ahead of the median price target. And if you can see here, it's never been this good in terms of the percentage in target difference against analyst consensus price target. Now, the consensus is not very meaningful in this case because there is not a strong consensus in the analyst community. There's quite a bit of dispersion in terms of opinions, but I think that's good because it could create a case where if we are right and the stock disappoints on the earnings, there could be a number of analysts downgrading it shortly after. So I think that creates an opportunity. Whilst not necessarily expecting an explosive downside move, we could see a string of downgrades if the earnings disappoint. And that's part of the reason why I would likely structure this play as a calendar. Now, like I mentioned earlier, they're about to report earnings, and the statistics in terms of the historical prices of the stock, average true ratio, show that there is a good chance it could get to $140 within a month. Now, I think that would be motivated by certain things. First of all, risks that the stock has seen in the past, the increase of theft in stores, which cost the company an estimated $100 million a year, and also their new strategy by which they're looking to compete with other players such as Amazon and Walmart and Costco with bigger stores addressing rural areas. Now, the problem with these guys is that for them to do that, they have to be able to operate in a way that is not gonna enable them to be that profitable. The reason for that is because unlike those other players, they do not have the pricing power to enable them to access that merchandise at the same competitive prices. And so by pursuing that strategy, they would definitely be behind competitors in order to deliver that value to the customer. Now, the other thing is their business model in terms of how they expand the stores. They have addressed in the last earnings call in December that they will be launching 800 new stores with 1,500 remodels and 85 relocations. That was not well received by the market because it was seen as quite modest. And the way in which the stock grew in previous years was through the openings of new stores. And there's a pretty good chart that you can see here that illustrates how the new openings of stores relate to net profit. So a slowdown of new stores could be interpreted by the market by a slowdown in revenue growth, a slowdown in EPS growth. Now, the other thing is how they open the stores, because unlike competitors, the way in which these guys uh, open the stores is not through leasing, but by the outright purchase of these locations. And what that means is that they need to be able to sustain strong cash flow generation in order to have the ability to do that. Now, when you put that with a company that has a dividend plus the earnings expectations, that could leave them a bit cash stripped. So at present, and this is the main risk that I see with a company as a trade, is that when you put the EPS and the dividend yield that they provide, that combined is about 6.3%, which is not bad compared to the 3-month treasuries at 5.4. Having said that, if EPS falls short or the company makes the decision of cutting the dividend, that would certainly impact the stock very, very negatively, because then it would make sense to hold other assets like treasuries. Now, the other thing that we have to bear in mind is the competitive landscape. We've already spoken about some of the players that these guys compete with, but there's a new player in town that you may have heard of called Temu. It's like an Amazon from China, essentially allowing you to buy products at lower prices with increased waiting times. And there's some data that's been released in the end of 2023 that shows that the market share for this company rose from 0% to 14%, while at the same time, Dollar General fell by 8%, right? So again, um, Temu has a significant competitive advantage because its products have fewer middlemen and no direct exposure to labor and theft issues that Dollar General has been experiencing lately. So aside from the theft, these guys operate in the lower margin business. They have low wage employees, and that obviously has been an issue for companies in terms of retaining talent. The other thing is competing on margins, and that's something that we have seen already. So 2023 EPS struggled because of this. Yes, there was an improvement at the end of last year, but let's not forget that the expectations back then was that earnings were down 30%. So even though it was a beat, that is still not such a good news. However, the market is starting to see the stock as the recovery has been fully priced in. In my view, it's priced to perfection, and it's priced for everything having to go right. And my experience is that if something does not quite meet those expectations, the stock can drop precipitously. So looking at the margins, we can see that, for example, revenues been slowing down significantly, gross profit margins as well, shrinking, EBITDA margin shrinking, net income shrinking, EPS, like we mentioned, not doing great. And yet we are currently at a PE which is above 2021 and not far from 2022. So at the same time, you have debt going up and cash flows still not doing quite as well as they did in previous years. So all that leaves us with a company that has a lot of issues to solve. Arguably, you could say that this is a business model that doesn't work as well as it used to. These days, you can buy very cheap products from Amazon. You don't even have to go there. And there are other players as well that they have to compete with, such as Five Below. Um, so those guys have been doing quite well. From a, a from a sector point of view, and this is from an EV to EBITDA standpoint to have a more accurate view because of the debt levels. I see the company has risen quite significantly over the last few months, and I would imagine that the valuation corresponds somewhere around the middle of the sector rather than leading the company due to all the numerous problems that we have mentioned before. That's where it's always typically seated on. Um, so my bet really here is that the company is gonna come back to those previous levels. So that's it for today. Hope you enjoyed the video. Subscribe and see you soon.